Us now as our featured guest is Peter Schiff, president of Euro-Pacific Capital. Peter, very good to have you here once again.
Nice to be here again.
And of course, the world has changed quite a bit since you and I talked last. You had been warning for quite some time that we were going to see problems, and indeed we are now. I want to start with that consumer confidence number. 38 is the reading. And it's the worst in 4 decades since records began. When you see a number like that, what does that tell you about where our economy is headed next?
Well, I mean, first of all, consumers losing confidence makes a lot of sense. I mean, it's actually a good thing, and these numbers are going to get a lot lower in the years ahead. I mean, we'll probably get down to 10, maybe below that number. But, you know, the problem in the past is consumers were overconfident, and all that false confidence is one of the things that led consumers to make a lot of irrational decisions, like not to save any money, to go out and borrow a lot of money that they really couldn't repay, and to buy things that they couldn't afford. And now that consumers are taking a more realistic outlook, although they're still not pessimistic enough, hopefully they'll rein in their reckless spending and actually start saving money again, which is what we really need.
Although, of course, consumers weren't the only ones spending. The U.S. government has been on a bit of a spending spree. And today, the U.S. Treasury's acting Undersecretary Anthony Ryan saying there will be unprecedented financing needs in 2009.
That's unfortunate, because even as consumers start doing the right thing, their government is doing the wrong thing. As Americans stop spending money, the government is spending even more, either directly on its own, or it's encouraging citizens to spend more money with their reckless stimulus packages. But all of this extra spending, of course, is financed through inflation. We don't have any money. We're broke. And all we can do is spend the money that we print. Now, we can try to con the rest of the world into loaning us money that we can spend. But the world right now is suffering as a result of all the money they've already loaned us that we can't pay back. So to expect the world to loan us any more kind of seems to be a big jump.
But wait, when you say we're broke, what do you mean exactly? If we're making payments, we're not broke.
Well, we're not really making payments. We're printing money. I mean, the U.S. economy is broke. We've borrowed trillions of dollars, right? And we used all that money to finance consumption. So we don't have anything to show for it. We don't have real factories. We didn't take the money that the Japanese and the Saudis loaned us and build factories so that now we can actually export products to pay back that debt. We spent all the money on television sets, on SUVs, on remodeling our kitchens. The money is gone. We can't pay it back. That's why all these entities are collapsing. That's why Wall Street is in so much trouble, because they engineered all these loans that have now gone bad.
You saw this crisis coming, as we pointed out earlier. What were the early warnings to you that we were going to be dealing with a very large problem?
Well, I saw this early on. I mean, basically, going back to 2002, 2003 is when I really started sounding the alarm bells. When I saw the extent to which the Federal Reserve was going to try to prevent the recession that we should have had following the bursting of the NASDAQ bubble, following September 11th, when I saw them irresponsibly lowering interest rates, and I saw the housing bubble forming, and I saw them throwing lending standards out the window, and I saw how much money we were borrowing, I began, going on television and writing about what the dire consequences were going to be when this bubble finally burst.
It's widely expected the Federal Reserve this week again will lower interest rates. Would that be a reckless move in your view?
Of course. I mean, rates are already much too low. What we need in the United States is much higher interest rates to both discourage borrowing and to reward savings. But of course, higher interest rates will, cause the recession, right, to unfold quicker. And the politicians don't want that. They're trying to keep the recession away, but the recession is actually the medicine that is going to cure the economy from the disease that infected it during the boom. But, the politicians don't want the recession to run its course. They want to pretend that they should print some money or pass a program and make the recession go away. They can't do that. I mean, it didn't work in 2001 and 2002 because now we have this huge mess on our hands because the government didn't stay out of the market back then.
Iceland's central bank raised its key lending rate to 18% today.
Yeah, that's what's going to happen to the United States. We're going to be hit by the same forces when the world yanks money away from us. Right now, it's kind of perverse, but the dollar has actually been a major beneficiary as this crisis has unfolded so far. And so our markets are actually being supported, our economy is being supported by all this deleveraging. As everybody is selling a lot of assets that they own around the world, they're moving into the dollar. This is a fake move. This is not going to last. Once this deleveraging ends, the dollar is just going to collapse like a stone. And when that happens, that's going to pull the rug out from under our economy and our markets.
All right, we're going to break away from this conversation for just a moment and bring you Welcome back. You're watching Open Exchange. Our guest today is Peter Schiff, president of Euro-Pacific Capital. You sort of threw a lot of ideas out, Peter, right at the start when we began talking. I want to backtrack a little bit and talk about the big government bailout plan to save the banks. Do you think the whole approach was wrong, that not only should Bear Stearns have failed, but Lehman should have failed, and those should not have been the only ones? Well,
sure. Well, Lehman did fail, but I think many of the brokerage firms that are now alive, including even Goldman Sachs and Morgan Stanley and many of the banks like Citibank, a lot of these companies would have failed, most likely, had the government not stepped up. And I think failure would have been better than propping them up. Now, the same thing happens, is true with the auto companies. I mean, why are we propping up these companies? If they're going to fail, let them fail. They were mismanaged. And when the government props them up, all they do is entrench the very bad management that bankrupted these companies in the first place. If you let them fail, if we let all these banks and brokerage firms fail, it doesn't mean that there won't be a brokerage industry or a banking industry. It just means that it will come under new management. The people that ran these companies into the ground will lose their jobs. Somebody will step up in bankruptcy and buy up the assets and do a much better job of running the businesses.
What about the argument, and certainly people said it with Lehman, people said Lehman should have been saved, that the counterparty risk is too great, and that's why we had to see the government make the moves.
No, look, I agree there's a lot of counterparty risk, but, we just got to let it work its way through the system, because people forget about all the bigger problems that the government creates when they try to solve a problem. Just because something is going to be painful doesn't mean that we have to resist it. We have to look at the consequences of government action. And remember, the government doesn't have this slush fund of foreign reserves to fund this bailout. The bailout is either coming from borrowing additional money or printing money, and it's creating a bigger problem. And you're taking all the losses away from the shareholders and the managers who really created these losses, and you're putting them on the backs of American citizens, or citizens all around the world who own U.S. dollars, who have U.S. dollar-denominated debt, or Americans who are earning dollars for wages, because our money is going to lose value.
And remember, it was just this morning, a short time ago, that the Treasury's Anthony Ryan said the government is facing some unprecedented financing needs. Let's listen into his comments.
This year's financing needs will be unprecedented. And we firmly believe that investors value greatly and pay a premium for Treasury's predictable actions, the certainty of supply, and the liquidity in the Treasury market. To the very best of our ability, we intend to stay the course.
What about that argument that investors will pay because there's liquidity, there's supply, it is the U.S. government backing?
They won't. In fact, the very reason that nobody should want to own treasuries is because there's all this liquidity, because there's all this supply. That's the problem. The supply is going to keep growing, which is going to ultimately collapse the price. When you're investing in something, you want it to be scarce. And if you look at the plans that the government is laying out right now, my guess is that we're probably going to borrow another $10 trillion over the next 4 or 5 years to finance budget deficits, to finance bailouts and stimulus plans. Who's going to want to loan us that money? And I would put the words loans in quotes, because if the world actually loans us the $10 trillion, it's not a loan, it's a gift. We cannot pay any of this money back. We are spending the money.
Okay, wait a minute. We can't pay it back now, but do you not have faith in the U.S. economy that we will be able to generate or produce again?
No. How can we do it? The money is not being, we're spending the money. Every day more factories shut down. We can never pay it back. It's like an individual. If an individual keeps borrowing money on credit cards to buy things, to take vacations, to buy products, how's he ever going to pay that back? If you don't have the income to pay it back, if a business borrows to make an investment, you can see, okay, they can pay the loan back out of the returns from the investment. But our government is borrowing money and spending it. Our citizens are borrowing money and spending it. All we're doing is digging ourselves into a bigger hole, and the more money the world loans us now, the more money they're going to have to loan us in the future. They have to continuously loan us more and more money and never ask for it back. And that's how we knew this credit bubble was going to burst. Our whole economy was built on consumer credit. And once the credit stops flowing, the whole economy collapses.
The very outspoken Peter Schiff is here the entire hour. We've got more with him coming up. Also, we want to take another look at whether the Fed's rate cut. We're back with our featured guest, Peter Schiff, president of Euro-Pacific Capital. Peter, you've been very vocal about what some of the problems are with the government's plan, where the U.S. economy is going. What about the fact that come January there will be a new administration in the White House? Do you have any sense of optimism that there might be some change?
None whatsoever. I mean, there might be some change only to the degree of magnitude that the government interferes. You know, the problem is they've misdiagnosed the disease. Everybody assumes, or at least certainly everybody in the Obama administration is going to assume that we're in this mess because of capitalism, because of too much greed. And they don't understand the government's role. The reason for all these bad decisions, the reason for all these bad loans was not the free market. It was government interference in the free market, right? It was the government, the Federal Reserve, that set interest rates down so low. That's the source of all the cheap money. It was Fannie and Freddie that guaranteed half the mortgages, which created the moral hazard, which allowed people to borrow beyond their means because people knew the government would step up, and you had a tax code that promoted real estate speculation.
What about the idea that we're going to get more regulation in a new administration?
We're going to get more regulation, but it's going to be more regulation that interferes with the market trying to correct from all the problems that were created during that phony boom. This is exactly what Herbert Hoover tried. It's exactly what Franklin Roosevelt did. And that's the reason we had a Great Depression.
But we didn't have credit default swaps back then.
But we had a malinvested economy. We had a credit bubble that was the result of monetary policy by the Fed. They blew up a stock market bubble. It burst. We were going to have a very severe recession or a 1 or 2 year depression, but the government turned it into the Great Depression because they interfered with prices, because they propped up failing companies, because they tried everything they could to ease the pain. And that's exactly what Obama's going to do. He's going to come in with a big mandate for change, to rein in capitalism. They're going to spend a lot of money we don't have. They're going to go deeper into debt. They're going to crank up the printing presses. They're going to tax the very people that we need to help dig our way out of this hole, the people who might actually provide legitimate employment opportunities and produce products. We're going to have massive unemployment. We're going to have rapid inflation, and our economy is going to tank.
You're an upbeat guy. You know that, Peter.
Well, I'm just looking at what's going to happen and not sugarcoating it.
Let's say we elected you president. What would you do?
Well, I mean, first of all, there's no panacea, right? There's nothing that we can do to immediately ease the pain. You know, we borrowed and spent ourselves into bankruptcy, and now we've got to deal with that reality. But what I would like to do, if I was in charge of the government, is the one thing the government can do to make the pain more bearable is to shrink its size, so that the government itself is a smaller burden on society. So what the government should be doing is cutting spending. It should be cutting military spending. Maybe we can bring our troops home from around the world. We can't afford to maintain this empire. We need to slash entitlement spending. We need to abolish entire government departments and agencies. We need to get the government a lot smaller, so then we can actually cut taxes and people won't have to support this gigantic government.
Politically, how are you going to cut entitlement spending, including Social Security, when people are looking what happened to their 401ks?
Well, look, I realize that it's difficult, but if we don't cut entitlements, the entitlements will be worthless, because what's going to happen is people are going to get their Social Security money and it's not going to buy them anything, because we're going to have massive inflation. So what good is it to get a Social Security check if you can't buy anything with it? It's better for the government to tackle the problem now, make real cuts in Social Security, and then if there are any payments to people who really need it, the payments will have some value.
And you think the dollar's going to go weaker from here?
Yeah, I mean, right now, this perverse dollar rally as a result of all this deleveraging, as a result of all the redemptions. But once this rally runs out of steam, and it will run out of steam,
right,
the dollar is going to drop like a stone. And then the problems are really going to get worse.
All right, we'll talk a little bit more about what's ahead as if it wasn't bad enough in Peter's view in just a moment. Stay with us. You're watching Bloomberg's Open Exchange. For more on some of the funding pressures facing American car makers, we turn to Peter Schiff of Bureau Pacific Capital, and we welcome Bloomberg columnist Daron Levin. Daron, it's always a pleasure to see you here.
Nice to see you. How are you? I'm
doing well, and there's never a shortage of things to talk about with the automakers. Let's get to this GM story here. First of all, do you think the government will come up with aid, and will there indeed be a merger now with GM and Chrysler?
Well, I think that this has to be a deeply humiliating event, first of all, for GM management to have to go on its knees to the government to bail them out. They've been on their way to this for a couple of years now, and they want to now merge with Chrysler. Chrysler is in as bad a shape, if not worse, than GM. In fact, it recalls the comment from Scott McNeely when Hewlett-Packard and Compaq were merging. He said it's like two garbage trucks colliding in slow motion. It's really a tough event for Detroit and for both companies.
So if you get these two merging, I mean, what is the point? Are we going to see a healthy company emerge out of two troubled companies?
I doubt it. What you're going to see is a lot of capacity taken out. You're going to see a lot of people lose their jobs. Several plants will close. A few product lines will go over to GM. Probably the Jeep brand will go to GM, which it wants. Probably the minivan, which it hasn't been making for a while. But will GM be healthy in that case? No, it won't.
Yeah, you mentioned it. They've lost $70 billion. I mean, why would we want to prop this company up so they can go on losing billions more? Why not just let them fail? You know, we need an automobile industry in this country, and I'd like to have one. But we don't need GM, and we don't need Ford and Chrysler. These guys have run the industry into the ground. Just let them go under and let other investors come in and pick up the pieces, pick up the factories, renegotiate contracts with workers, and create a viable automobile industry. Why do we want to prop up the one that we have that obviously doesn't work?
You mentioned Ford. Jerome, let me ask you about this. Kirk Kerkorian, again, reducing his stake, obviously not a vote of confidence for Ford's management and really an about-face from what we saw several months ago.
Well, we know now that he sold another big part of his stake, and that'll take him under 5%, so he won't have to disclose after today, and we won't really know what's going on. But he's made it pretty clear that he wants to get out of Ford, and this is connected to two things. One is the collapse in price of Ford stock. The other is the collapse in price of MGM stock, which he posted as collateral when he borrowed the money from Bank of America in order to do this acquisition. Kerkorian has a mixed record in the auto industry, and I think it's safe to say that he's gotten his fingers burned badly this time.
Jerome, have we fully seen the potential spillover effects as we watch what happens to GM and Chrysler, to the parts suppliers, and all the other industries connected to the automakers?
Well, you can see all their share prices are flattened. A few of them are out of business, and it's going to get worse before it gets better. There'll be several more mergers. Yesterday, Johnson Controls said that it was closing a plant down in Ohio that supplied seats to the SUV plant that's being closed by General Motors. So the spillover effect is massive, and it's not just to the first-tier suppliers, it's to the second, third, and fourth-tier suppliers.
Well, the problem is, why would it get better? When you have the government involved, it's probably going to keep getting worse. And once they know they can get bailouts, they'll just keep losing more money, and then they'll go back to the government and ask for more money. And that's the problem, is the deeper they get, the more money the government loans them. Now they come back and they say, well, now we need even more, and they get into this trap where you keep throwing good money after bad money.
Well, it's not going to be like Chrysler then, Jerome, because there's precedence when Chrysler sought a bailout.
Well, when Chrysler got a bailout in the early 80s, the government took warrants. First of all, the government only guaranteed a loan. It didn't put up its own money, so it was on the hook for the loan if Chrysler didn't pay back. Chrysler did pay back, and the warrants became worth a lot of money, I think $400 million. But the point is, a lot of people said at the time that what this was going to do was prolong the inevitable for Chrysler. And we see, in fact, today that that's what's happened, is that Chrysler now is being bought.
People hold up that Chrysler bailout as a good precedent, say, look, we did it then and it worked. Well, it didn't work. Look where Chrysler is today. Maybe there would have been a better company had the government let Chrysler go under and not guaranteed the debt. And I think we set up a bad precedent. There's nothing in the Constitution that gives the government authority to guarantee the debt of private companies. This is not something that the government should be doing. And, of course, the government likes it because it's a contingency liability that they don't actually have to put on their books. So it seems like it doesn't cost anything, but then when the loan goes bad, it costs a lot.
Final couple comments to you, Jerome. Do you think that GM will get the money from the government? Any sense from
it's a great question. I think they probably will get the money, and I think we are seeing unprecedented activity now in Washington for two reasons. One, because of the credit crunch, but also because we're in a presidential season, and nobody wants to undermine their party by failing to do something. So the Democrats are doing it, and the Republicans.
Yeah,
unfortunately, Jerome Levin, Peter Schiff, you're going to have to hold your thought because I've got to take a commercial. Jerome, great to see you here in New York. Look forward to seeing you again. We'll be right back. Stay with us. We're back with Peter Schiff of Euro Pacific Capital. Peter, I want to talk strategy a little bit with you right now. If you took your own advice, right, and avoided investing in the U.S., you had to put your money somewhere. You don't like cash if we're going to have inflation, right? So as an investor, what do you do in this time of uncertainty? I know you've written a couple of books on this.
Yeah, well, I wrote two. The first book I wrote was called Crash Proof, which came out in early 2007. And I just followed up on that book with a book that just came out a few weeks ago called The Little Book of Bull Moves and Bear Markets. Now, basically, the strategies that I outlined in both Crash Proof and in the Little Book right now are actually not working, right? My strategy was to hold cash a lot of that cash being in foreign currencies. Some of those currencies are doing well, like the Japanese yen, but other currencies like the euro or the Australian Canadian dollars have fallen. All of this really in the last few months. Own precious metals. Now, since I wrote my original book, Crash Proof, gold prices are a lot higher, but they're quite a bit lower than they were 6 months ago. Same thing with commodities in general. And I also recommended buying foreign stocks. And I knew we had to get out of the U.S. market. And I recommended buying dividend-paying foreign stocks. All of those types of stocks that I recommended, which were doing very well probably from 2000 to 2007, have collapsed this year. And foreign stocks are way down. The dollar is up. But I think this is very temporary. I think this is a fire sale going on due to deleveraging. I don't think these prices are going to be here for long. I don't think the dollar is going to hold these gains. It is a great opportunity for people to implement the strategies in those books right now to get out of their overpriced U.S. stocks, to get out of the dollar, which is going to collapse.
So buy foreign stocks.
Yeah, I mean, there are stocks now at 2 and 3 and 4 times earnings. Stocks are cheaper in Asia than they were at the depths of the Asian economic crisis. You can buy incredible dividend yields right now, and you can get rid of the dollar at exchange rates we haven't seen in years and that are not going to exist in the future.
But aren't the Asian economies also going to feel the effects of what's happening in the U.S. and elsewhere? Today, I want to point out the Baltic Dry Index dropped below 1,000 for the first time in 6 years.
They're going to feel this temporarily. Remember, we're broke. They were the major lenders of money. They supplied us with credit and goods. We're broke. We can't pay them back. This is causing financial problems as Asia has to absorb these losses. But going forward, when they cut us off, when they stop lending us money and supplying us with goods, their economies are going to boom. There is real economic growth going on in Asia. There are real factories producing real products. People are saving their money. There's a real economy there. And what's going to happen is instead of shipping all their stuff to us, they're going to keep all their stuff, consume it themselves. Instead of loaning their money to us to blow it on consumption, they're going to invest that money productively at home. So after the dust settles, there's a tremendous boom that's coming. You want to invest in that. You want to be positioned for that. The United States, on the other hand, is going to fare much worse. Our phony economy that has been propped up by the rest of the world is going to collapse. And when Obama comes in, he's going to put several nails in the coffin. It's going to be a long time before there's any growth here.
The election is a week from today. It hasn't happened yet. Just point that out a couple times.
I know, but
referring to the Obama
well, look, no one's going to vote for 4 more years of this. I mean, they're going to grasp at straws. They're going to vote for anybody who promises change. Unfortunately, the change that we need is less government. It's less interference. So we're not going to get change with Obama. We're just going to get more of the same, only worse.
Yeah, but look at Asia. It's managing to grow, and you could argue there's a lot of government interference there, depending on the country.
There's government interference everywhere. It's just a question of degree. And there's a lot more freedom. There's a lot more capitalism going on outside the United States than inside the United States. There's real wealth. I mean, look at all the stuff that we're buying. Look at all these products that are on shelves in America. How did they get here? There's factories around the world that actually made all this stuff.
Was one of our biggest mistakes losing our manufacturing base in the U.S.?
Well, of course. I mean, and the reason we lost it was because the dollar was the reserve currency, and we got lazy. We got to the point where we could just print money and export it, and the rest of the world sent us stuff. You know, when you actually have to produce things, it requires capital investment. It requires savings. You know, when you just consume, it's real fun. You know, you just spend your money. And so we developed this phony economy that was destined to collapse.
We're going to spend some more time with you in just a moment. We've got final thoughts from our featured guest coming up, Peter Schiff of Euro Pacific Capital. You're watching Bloomberg's Open Exchange, 51 minutes past the hour now. We're back here with Peter Schiff, president of Euro Pacific Capital, has been our guest this hour in Open Exchange. Peter, we don't have a lot of time left, but I've got to ask you about housing prices. S&P Case-Shiller Index down 16.6%. Again, another new low there. I'm going to doubt there's anything encouraging from you as far as house prices.
No, I mean, house prices have to continue to fall. You know, a lot of people think the problem is that housing prices are falling. We need to stabilize housing prices. That's not the problem. Again, that's the solution. The problem was that housing prices got much too high. They need to come down. They're still not low enough relative to what Americans actually can afford to pay for houses. So I think prices still have a long way to go on the downside. And unfortunately, these government bailouts that they have is going to encourage more people to stop making their mortgage payments in anticipation of a reduced mortgage from the government when the government buys their troubled loan from their lender. So I think we have a lot more downside in housing.
When you say long way to go, how much lower?
Well, I mean, you have houses prices now where, houses are selling at 30% or 50% off their peak valuations, but you still have people looking to sell houses, and they put their houses on the market, and they put the house on the market, at a price that's never going to sell. It's nowhere near where the foreclosures are taking place. The foreclosures are the real market. And when homeowners understand this, come to terms with this, and when lenders and banks come to terms with the foreclosure market is not an aberration, that's the market, that houses are worth half of what people think, that's going to have a dramatic change on the way Americans run their lives, because people are operating under the fantasy that the house was the source of all this wealth when it's not.
Peter Schiff, have to end the conversation there of Euro Pacific Capital. Thanks so much for being our guest.
Thanks for having me.
Appreciate it. Thank you for joining us.